Right then, good evening all. Just wait a couple more minutes, just got a couple of more people to add in. Before we start, just to let you know, this webinar is going to get recorded. But look, welcome to Succession Retirement Planning. So what to do with your premises. This webinar has been put together in conjunction with a few of your LMCs, so Lothian, Grampian, Lanarkshire, Arran Ayrshire, Borders and Forth Valley LMC. So thank you to all of those who have assisted with the process. I'm your host, Will Ellis, so one of the co-founders and sales marketing directors for a company called BW Healthcare Surveyors. So we are a specialist primary care surveying firm with clients all over the UK, and we've provided help and support to more than 1,000 practices since the company was launched in 2017. I have gone through the attendees list yesterday, so I think a few of our clients are actually joining the webinar today, which is great, and a lot more of you I think I've had conversations with over the years. So welcome to you and everybody else who has taken the time to join us. I'm also going to be joined by three specialist primary care speakers. So the first one is one of my colleagues, James Williams. He is a fellow director at BW Healthcare Surveyors, and James has been assisting GP practices all over the UK with various premises related matters for the last 15 years. So he has expert knowledge in all areas relating to notional rent reviews and disputes, market valuations, lease renewals, rent reviews, sale and leaseback, and the primary care investment market, which is something we're going to get onto today. We're also joined by Andy Drane, who is a partner with commercial law firm Davidson, Chalmers, Stewart. He is a highly experienced advisor to medical practices in Scotland with over 30 years working in the sector. Chambers and Partners, Chambers and Partners, the leading legal ranking organisation, rates him as one of the top 3 lawyers in the whole of the UK advising in the primary care sector. So he knows what he's talking about. He works across all health board areas, giving a unique insight into the different approaches to business of primary care delivery. And he is adept at helping practices understand the commercial issues they face and finding innovative solutions to their issues. And last but not least, we are joined by Pauline Hogg, who is the Managing Director at Accountancy First Condies. She heads up their specialist division, Condies Health. Condies look after around 190 practices throughout Scotland, so around 25% of all practices in Scotland. And they offer accountancy, taxation, bookkeeping, payroll, benchmarking, advisory and pension advice to their GP clients. So Pauline specialises in the medical sector and has done so for over 20 years. So Pauline is also the only Scottish committee member of AISMA, who are the Association of Independent Medical Accountants. So we'd like to think that we know what we're talking about when it comes to primary care issues. And some of the things we are going to be going through, or certainly my 3 guests will be talking you through today, are some of the options when considering your succession and retirement planning. So things like the premises directions, so how your premises are valued, what you need to consider when you have a partner retiring or leaving the practice, sustainability loans as one of the options, how that might benefit your practice, and the other options available to the practice, including things like sale and leaseback. We will then, if we have enough time, answer some of your questions. So if any of you have any specific queries you would like answering, or anything we talk about today explaining in more detail, please just type your questions into the Q&A box just at the top panel of this window, and we'll go through the questions at the end. Right, okay, so on to the actual webinar. Let's start with some of the basics. Can my guest talk to us about the principles where property is held by the practice and the partners?
Good evening, everyone. I thought I'd kick off here by probably starting a little bit with probably what governs the basis of premises reimbursement really across the country. And I think certainly this is something Andy can talk about certainly as well. So we've got the premises cost directions, which really, in terms of the principle of property owning, GP surgeries that are owner occupied, the premises cost directions it's the national, it's a statutory instrument that covers the reimbursement of premises costs. It is a legal document, and that covers the reimbursement of all premises costs for owner occupied GP surgeries. Now, in terms of, there's 2 main systems of reimbursement covered by those directions, and that is a cost rent system, which is the reimbursement of borrowing costs, and is purely based on the repayment basis of any loans or borrowing that's been incurred as a part of development of buildings or purchase of buildings. But the main one is notional rent system, which is fundamentally a market rent system that is based on a set of assumptions set out within those directions, that is assessed by the district valuer as appointed by each health board, and that is reviewed every 3 years and that is a rolling system of reimbursement. And I think those directions are they've been in various guises and forms prior to that. Certainly, Andy, no doubt you can tell me the different forms that they were before that, undoubtedly.
Yeah, but some of you will remember the terms of the Red Book. I mean, the premises cost directions are the replacement of the Red Book that was in place for many years beforehand. I mean, these are the fundamental building block of how the provision of GP premises is provided. If you go and speak to any of your friends who may run businesses, be they accountancy, lawyer businesses, or indeed any other business, they have no idea what you're talking about, because in the rest of the normal commercial world, you don't get paid this separate slug of money for providing premises, but it is a fundamental part of how GP practices, GP businesses are funded, and premises issues, and we'll come on to talk about some of the issues around that, but premises issues can be some of the very fundamental and existential issues for you facing in terms of running your business. Sorry, James, I cut across you there.
No, not at all. I mean, from my perspective, as a valuer and as a surveyor, I will focus on the premises reimbursement elements, which tends to be generally the notional rent, which, as I was sort of mentioning, is its market rent basis system. It's reviewed every 3 years. It's assessed by the district valuer. Now, as many of you will know, that valuation is itself an opinion, and the district valuer forms that opinion based on a series of facts. And so your notional rent assessment will be based on the size of the building, the condition of the building, the standards of the building, also where it is. That's an aspect you can't particularly change, of course, but you can change things like the building itself. And also, it's key to just point out that one of the first aspects we'll touch on as a principles of good solid estates management is looking at when that assessment is reviewed and what that opinion is from the district valuer, and potentially looking at are there any aspects that may have been missed, or they're looking to potentially challenge that. And understanding the basis on which that it's valued. So we look at the standards of the building. The district valuer will look very closely at compliance issues, infection control, things like that. So improvements to a surgery, and it touches really on key valuation points that can really help enhance a surgery's value. So improvements of different aspects within the building, because the way in which we value this an ongoing business and ongoing practice as a GP surgery is to look primarily at the notional rent, the current market rent that's receivable, and we look at applying a multiple that capitalizes that from a notional rent into a capital value. So ways in which we can enhance notional rent through improvements or assessing how that's been assessed can really help drive value of premises. That really helps future-proof buildings as well. So it all goes hand in hand. If a building is continually improved, it helps the future progression and state of the building going forwards, and it helps the building value generally.
Perfect.
Shall I just
Thank
touch
you.
on the account side of things?
Absolutely, please do.
Yeah. So I suppose where property is owned by the partners in the practice, the property should be valued under fixed assets in your balance sheet and your accounts. And the value reflected in the account should be based on the method of valuation that's stated in your partnership agreement. And I'm sure that Andy will come on to partnership agreements in a moment. Any practice loan funding should be under your liability section in your balance sheet and your accounts. And each property owning partner should have a capital account, which represents their net equity in the property. So say a property is valued at 500,000 and the practice has a bank loan over the property of 400,000, then the net equity would be 100,000. So in principle, you sell the building for 500,000, pay off your loan of 400,000, and you've got 100,000 left to pay out to the partners. If you had two partners owning the property 50-50, they would obviously have a capital account balance of £50,000 each. When you do own the property, it's important in your accounts that you do have a capital account, but you also have a current account. So a capital account is really your net equity in the building. Your current account is what represents your working capital in the accounts. And that's really your day-to-day fund to run the practice. So they're very different, and you'll probably hear your accountant speak about capital and current accounts, but it's very important that there's a distinction between the two. Individual partners might have their own loans when they've bought in for the property, and they sit separately out with the balance sheet. And so to work out a partner's net equity there, you take their capital account in the practice, less any personal borrowings that they may have. Now, partners can own the property in various arrangements in line with sessions is generally the norm, and probably one that I would recommend because I think it leads to less issues in the practice. But I do have practices where they own the property equally and some bizarre other historic basis. The rent received from the Health Board should be allocated in line with property shares. Your loan interest and any specific costs should be allocated in property shares too. And where the property shares don't match with profit shares, it's really important that considerations given to how the allocation of costs, such as redecoration, large capital expenditure like roofs, windows, boilers, who picks up those costs if you don't have, if you've got a wee bit of a mismatch between property and profit shares. And again, that should be in your partnership agreement. One comment I hear a lot of from an account's perspective is, I don't make any money on my building. I think it's important to understand what profit you make, but also what cash you receive from the building. So profit is the difference between your rent less your loan interest and any other costs, and that's what you're taxed on, that's your profit. But if you're paying capital in your bank borrowings, that's not a cost against profit. That's effectively what I would call forced savings. So as the property, as you pay off your loan, you build up equity. So a bit like your home, you pay off your loan, you're building up equity, but you just don't get that money just now. You'll get it later on when you either leave the practice or if you refinance and do a wee bit of equity release. So depending on your loan arrangement, you could see no money but still make a profit and have to pay tax. So that's probably a wee bit of a summary in terms of basics for property. Well, and probably this is probably a good time for Andy to pick up on partnership agreement.
Yeah, and I mean that leads very neatly into talking about partnership agreements. Very generally, you need to have a partnership agreement. If you don't, you're relying on legislation that was written in 1890. That's 1890, not 1980, when Queen Victoria was on the throne. And business and partnerships looked very, very different, whatever that is, 160 years, 130 years ago. The benefit of a partnership, a properly thought through partnership agreement, is that it sets out the deal amongst you as partners. And agreeing a partnership agreement at the point when you're all on the same sheet, when you're not under pressure to deal with issues and such like, and you're able to have a sensible conversation that says, okay, what is our agreement about a whole range of things? And in the context of property and premises, things like what Pauline was discussing there about who is liable for costs and how are those shared up. How do you plan forward for the replacement of the central heating boiler and such like? There's going to happen at some point over 20-year lifetime. How do you build up a fund so that those unforeseen costs aren't suddenly coming out of 1 year's 1 year's profits? And particularly important, this ties back into what James was talking about. When someone joins, what is it that they're actually having to pay to join in the practice? And when someone leaves, what are they being paid out? It can be tempting to think, well, a building is just worth whatever it's worth. Now, a significant part of what James and Will bring to the table is actually being able to say, well, that's not what valuation is about. There are different bases of valuation, and we'll come on to talk about sustainability loans and the values that might be being used there, and how that is very different from what you might call as alternative use or bricks and mortar value. You want your partnership agreement to be very clear what the basis of valuation is particularly when someone leaves. So are they being paid out on the basis of investment value? Are they being paid out on the basis of bricks and mortar value? And the difference between these valuations can, in some circumstances, possibly in many circumstances, be very, very substantial. And if you've not dealt with that at the point when there's no contention, it has the capacity to become very contentious, sometimes existentially contentious. James, do you want to jump in?
Absolutely, and it is something that I will come across now and again. Unfortunately, it is this concept of a consistency of approach. So it's one approach or another, whether it is to look at other aspects, including alternative use, or whether we are looking solely at the existing use value of the building as a GP surgery, which in the main it is in terms of what's included within partnership agreements. But if there's any vague elements there, it can present an element of unfairness as to the basis under which one partner joins and buys in and then one subsequently leaves. So it is really important, what Andy's saying, to get the partnership to cover that aspect as well.
Great, thank you all for that. I think you all explained the principles very well there. So what should practices be considering if they have a partner retiring or leaving the partnership?
I suppose from an accounts perspective, you need to establish what you need to pay out. So what is the capital balance going to be? And that is looking at the date of departure. So that's, if you remember, an equity capital account is the difference between the property less the loan balance. So for our practices where we know a partner's leaving, we can estimate what the capital balance is going to be. So projecting forward the loan balance. What we might not know at that point is the up-to-date valuation. And I would always strongly recommend evaluations carried out as one of your biggest assets that you hold value to. And property values can change. So getting an up-to-date valuation close to the date of departure, and then working out, right, what is the capital that you need to pay out to that outgoing partner? And then it's reaching for your partnership agreement to find out when you need to make that payment, how quickly that you need to make that payment. And that's where it almost goes back to drafting your partnership agreement. What's realistic in terms of paying a payment out? And a lot of partnership agreements that we see, yes, they've drawn up and kind of is how they feel is fair, but actually in practice sometimes it doesn't work as well. And I think also consideration if a partner's got personal borrowings and how that's going to work through the system as well. So I think it's looking at what's in line with the partnership agreement in terms of payout. Is there a partner coming in? Do they buy into the property straight away, or they've got a 6-month kind of probation until they buy in? Or do you not have a partner? Maybe you're replacing or you're changing. You've got a salary partner there, but not a partner. So do they effectively, the continuing partners need to buy that outgoing partner out? And then how do you fund that? Obviously, with high interest rates at the moment, borrowings are more costly. So I think it's looking at what are your options. It doesn't always need to be doom and gloom at the moment. I think it's looking at what options are available from the high street banks. And one option that is on the table at the moment is sustainability loan. And I think Andy and myself will come on to that in a moment, but it's looking at what your options are. So how much you pay, when do you need to pay it, and what your options are in terms of funding.
Yeah, and I would jump in there. I mean, I think that's absolutely right, Pauline. And I think one of the things I always encourage practices, and you're the same, Pauline, is remember that you are businesses. You know, that you are private contractors and that you have a business there to run. And all of us as professionals, when we're running our business, we're trying to be able to manage some of these business risks so that they don't suddenly jump up on us and we're having to turn around and deal with things on the back foot. But looking at planning, and I know your sector is very difficult just now with recruitment and retention of not just staff, but of partners as well. But trying, if you can, to forward project what is the timescale for various people retiring from the business, and making sure that you're managing to plan for those retirements in an orderly fashion. Order is always going to be better than disorder when it comes to running your business. And of course, I go back to being a bit of a cracked record there, saying, you know, actually, it's what's in your partnership agreement. That is the legal position, is what you've set down there. Now, it is open to you to decide in a given situation that you're going to depart from what's written there. But actually, your only way to if you are unable to agree is always to go back to the partnership agreement. The other thing, and it's a very granular, basic thing, but when someone is leaving the practice, or indeed when someone is joining the practice, make sure that in return for getting paid out that capital, they remove themselves from the property, from the title deeds. The number of circumstances, particularly in the context of sustainability loans, that we have come across, where practices have doctors who still own the property in trust for their current partners, but who long since left the practice. I had one recently where a doctor who was a partner in the 1980s, still was on the title deeds of the property. Now, aside from the difficulties of being able to track that person down, physically persuading them that they have anything to do with some business that they were associated with last century. Remember, that's what we're talking about, last century. Is difficult. And of course, there are some former partners who will be very benign and they will do anything that you ask them to. But, you know, from time to time, we do come across former partners who are positively malign and who will seek to not necessarily extract money from the situation. They're not able to do that, but who will make things difficult for you. So the simple lesson there is, in return for getting paid out your capital, you sign the deed of resignation and conveyance of the property interest.
Absolutely. And I'll just reiterate something Pauline said at the very beginning of that point about valuations, how they can change over time. They can change potentially significantly, and again, it can link to the basis of that, but it's a key point. And partnership agreements can set out obviously what can happen in the event of a dispute from a valuation perspective, whether or not it then has to involve the appointment of an independent expert accordingly. But these are all things that need to be thought about and factored in.
Fantastic, thanks all. So obviously I know you've mentioned before, Andy, how important it is to have a partnership agreement for those who don't already have one, but for those who do you think it's kind of going to be good to be part of the process and important for practices to have their partnership agreement checked so they can actually understand what the terms of their agreement are?
Yeah, very, very much so. I mean, I think that there are two things there. One, you don't want to have a partnership agreement that is just taking your current high street lawyer's own partnership agreement and changing the names and replicating it. You operate in a very heavily regulated sector where the financing and the rules that you have to play by are very different from other professional advisors. There are things that very specifically apply in your sector. So things like 24-hour retirement. If you explain to any other professional, they'll have no idea what you're on about, and yet it's an important part of the operation for GP practices. And there are many of those sort of issues that get drawn out, and it's important that people who have joined the practice over the course since the partnership agreement was last written, one, actually sign up to it so that they're legally bound by the thing, but also that they understand what it is that they've signed up to, and that process of making sure that the practice regularly considers what the terms of, I called it the deal, what the deal is between the partners. That doesn't mean you're going to go and change it, but that everybody is aware of what they've said they're going to do and what they're not going to do.
Great, thank you very much for that. So look, let's go into a bit more detail about one of the options. So sustainability loan. So what is the sustainability loan and how could it potentially benefit practices?
Okay, so let me jump in here. So 2017, the new contract, I'm old enough to remember the original new contract from 2004. The new contract was promoted by Scottish Government and BMA Scotland as being a new settlement. Two documents came out at that point. One was described what the contract was, and one was an entirely separate thing called the National Code of Practice for GP Premises. US practices, or those of you who were in practice at that point in time, voted for that, and as of April 2018, the new contract came into play, along with the particular policy drivers that were set out in the National Code of Practice for GP Premises. For those in owned premises, the great idea, the great resolution and the panacea for all ills was sustainability loans. And sustainability loans are 0% loans, so no interest being charged on them, evergreen, so they never have to be replayed, unless you cease to provide NHS primary care services from your property. The intent, and it's set out in the National Code of Practice, is that sustainability loans will increase the stability of general practice, increase the incentive of being a partner in a practice which owns its premises. So that was a great idea. I think the reality was, for many practices, when in July and August 2018 they started to get their existing use values through from the district valuer, that actually they were maybe destabilizing rather than stabilizing for practices. And that's because it's tied back to what James was describing about valuations and the different methods of valuation. An existing use value is a value that takes into account the notional rent that's being paid for your building. And by and large, and James will tell me I'm oversimplifying this, but by and large, unless you're in one of the swanky buildings in the city centres or affluent suburbs of Glasgow or Edinburgh, the existing use value is going to be significantly greater than the alternative use value. In some circumstances, very substantially more. Where have we got to with sustainability loans? Well, originally there were about 60 practices across the country applied for sustainability loans, so a modest number of owned premises. The Scottish Government decided they were going to grant those loans to every practice that applied, and I think the first one that so we're involved in about 30 of those 60. It's about half of those sustainability loans we're involved in. And the first one, and it was one of Condies, one of Pauline's firm's clients who drew this down. I think the first one that drew down was in March 2021. And there has been, until the latter part of last year, a slow trickle. Why is that? Well, it's because whilst there was this great policy created at a high Scottish Government level, each individual health board was tasked with putting in place its own process and its own system for drawing down sustainability loans. And whilst they operate within the same framework, there are subtle differences between health board areas as they work out what they're going to do. Tranche 1, so you've heard talk about different tranches. Tranche 1 was is 20% of existing use value, and the intention being that there'll be up to 5 tranches over time. So tranche 2 being another 20%, and so on and so forth. Those practices who have been able to put forward special circumstances, some have been able to draw down more than that. Those would be the exception rather than the rule. I think one thing with sustainability loans you need to be very aware of is that the quid pro quo for being given this free money is that you also give the health board, Scottish Government, an option to be able to buy your premises, and this could cause some consternation, some issues for practices. Firstly, it's an option. It's not an obligation. So lawyers talk about rights and obligations. An option, it's a right, it's not an obligation. So actually there is no prospect necessarily that your buildings will ever be bought off you. Equally, you need to be aware that the sustainability loan process doesn't, if you turn around and say, actually, you know what, we don't want to sell our building to the health board, but there is a mechanism in the sustainability loan contracts that you sign up to, which allows you to say, actually, I'm going to put a hold to this, and we're going to pay off the sustainability loan, and we'll go and fund the building in a different fashion. The value that you would be paid if the health board does exercise the option to buy, that's going to be based on the market value at that point in time. Now, then the option could be exercised tomorrow, highly unlikely to be exercised tomorrow, but could be exercised at any point in the future. And assuming you're in a world where there are an inflationary environment where property values are inflating, then there's a reasonable expectation, not a guarantee, but there's a reasonable expectation that at the end point when the option to purchase is exercised, that there will be a greater value you're buying that. And I suppose my general view with things is that 20% existing use value is probably a pretty benign circumstance. I think, and Pauline, I'm sure you and James would agree, where the issues become further down the line is when you've borrowed 40, maybe 60% of existing use value, and you're looking at a situation where if you were to go and sell the building, you would struggle to get the level of sustainability loan back. But these are things for another day. There is no guarantee. I think it is pretty certain that tranche 2 will now come through, but there's no guarantee that tranches 3 and 4 will come through. And I mean, Pauline will go on and talk about interest rates and the benefit of that. But you need to be dealing with the here and now.
So we've seen a few practices now that have taken out sustainability loans, and I would say that most have used it to swap existing debt. So swapping maybe Bank of Scotland, Royal Bank, Aviva debt with sustainability loans. And as Andy says, they're no interest, no capital repayments. So certainly at the moment with high interest rates, if you're swapping debt where you're on certainly a variable rate, we've seen quite a few practices where financial pressure in terms of increase in variable interest rates, huge impact if it's a big property. So interest-free, capital-free, so you're getting all your money out, you're building up that forced savings that you may have been doing in the past. Obviously, there's a cost up front, but that absolutely will be recovered over future years. Practices need to be careful for repaying existing loans, just in case there's any redemption penalties.
Yeah.
Now, with high interest rates, there's less likely to have interest redemption penalties. And if you do have an Aviva loan, it may be a time to look at whether it's a good time to refinance, because Aviva loans were traditionally high interest rates. By repaying them, they're effectively going to recharge you the interest that they've lost in that loan. So where interest rates are lower and you're in a high Aviva interest rate, they're going to miss out on more you repay. So that's what your redemption penalty is. But where interest rates start to go up, I've seen quite a couple of practices where it's actually a good time to switch, but that's obviously an individual basis. One thing I just touch on, Andy, all partners have to be practicing in the premises. They can't have that are ex-partners that are holding the property for investment purposes or whatever. So they need to be partners in the practice.
And that's a really good, thank you, Pauline. That's a really good point to raise. It's a loan to the practice. So the people who sign the loan documents are all of the partners, including those partners who may be non-property owning. And that's an important part of your partnership agreement, that if you're in a situation like that you have the property owning partners are indemnifying the non-property owners for any liability that goes with that.
One question I get asked a lot, is there tax payable if you take out a sustainability loan? The simple answer is no. You're not selling any share of your property at this point. You're not selling your 20% or your 40%. You're really just restructuring your finance over the property. So there's no sale, there's no capital gains tax. It's simply how you're funding the building. What you also need to watch, if individual partners have got personal borrowings, you need to make sure that to get tax relief on any borrowings, you can't have loan funding that's personally that's in excess of your capital balance in the practice. So if you have a capital balance of say 20,000 because you've taken out some sustainability loan, if you've got a personal loan, say a 50, cannot get the full interest relief on that because HMRC will say, well, you should have used that money to repay your personal borrowings. So there's a wee bit of planning that you need to do there just to make sure that you maximise your loan funding, but also that you make sure from a tax perspective everything's all above board as well.
And from my perspective, just touching briefly on what Andy was saying in terms of the valuation basis for these, the EUV or existing use values or market value in its existing use, as Andy was saying, really is driven by the underlying market rent basis that drives notional rent essentially. So, the capital value is fundamentally affected by that. And as Andy said, unless you're in certain areas where there are very, very high alternative use values, that will tend to end up with the highest capital value you can secure. Where problems could arise in the future, and again, it's to reiterate, not necessarily worth dwelling overly on what could happen in the future because none of us really know, and values can go a number of different ways. But is if the method of valuation potentially has to change to an alternative use, where we also have to look at the things like the physical conversion costs and what is the building that we're valuing? Is this a purpose-built building? Is it a converted form of dwelling that's been extended? Is it actually an office building that could be used for? There's all kinds of different costs to be considered and implications that do affect competing alternative use, and potential issues can occur where you're in deprived areas, for example, as well. These things more influence alternative use than existing use directly.
I think what I've seen in practices is that should probably destabilise practices a wee bit in terms of, I think it's really opened up people's eyes to valuations and the different valuations that are there. And what should we value our property at in our accounts? And general practice is precarious. And what happens if you have to hand back your contract? What happens in those situations? So I think it's understanding what's the method of valuation and what could happen in a worst case scenario, so that you all understand kind of what the implications could be. And I think when you're drawing down sustainability loans, I think it was clear in the guidance that you can have a different valuation in your accounts compared to the valuation that's used for sustainability loan. The premise for that was really just to almost calculate how much they were going to give you. And it was a wee bit of a broad brush calculation and valuation, but it's purely for working out what that 20% loan that they're prepared to give you. It does not mean that you change the valuation in your accounts, because obviously that's based on what's in your partnership agreement. And I think practices need to be very careful that they don't end up in a negative equity position. So that's where your loans, high street loans and your sustainability loan is in excess of the property value in your accounts. I would strongly recommend you don't get in that position, because you have negative equity, you have negative capital balances. So if you leave, you then need to pay that money back. So there is a wee bit of kind of work and refinancing. We do quite a lot with our practices in terms of, right, what does this look like before and after? How does your balance sheet look to make sure that you're still kind of solvent in terms of how that looks? And then going back to partnership agreement is making sure that there's a clause in your partnership agreement if you've got negative equity and negative capital accounts. When does a partner have to pay that back? So yes, it's great, the sustainability loans. I think it's great, especially the current climate with high interest rates, and you want your money now, not paying off capital towards building up equity. But you just need to bear in mind valuation and also your equity position in the practice, and if you've got personal borrowings as well.
Yeah, and I think that's go back to what I was saying when I was describing what a sustainability loan was. Yes, it's 0% money. Yes, it's evergreen, but, and Pauline touched on there, that there are certain circumstances, very limited, when it will have to be repaid. But one of those is handing back your contract. And probably the last thing I, as a legal advisor, want to be in a position of is a practice turning up saying that's taken a sustainability loan out, has handed back their notice and comes to speak to me 3 months into the 6th-month notice period and saying, well, this is what we've done. I'm going to find that quite difficult to be able to extricate you successfully from that situation. So you are ceding a bit of control there in terms of that ability to be able to unilaterally hand back your contract without there being consequences. That said, of course, if you hand back your contract and you've got a loan from RBS or Aviva or Bank of Scotland, you're in a similar position. You still have to pay that back. And I suppose one of the things I will have some practices assuming is that a sustainability loan is a gift, it's a grant. It's not, as a matter of law, it is a loan, and loans in certain circumstances do need to be repaid.
Fantastic. Thank you all for that. So, look, other than perhaps the sustainability loan, which I think you've all covered brilliantly there and in great depth, are there perhaps other options available to practice, other things for them to consider when going through the succession and retirement planning?
One option is a sale and leaseback scenario, and this wouldn't be suitable for different practices. It would be suitable for some. This is where an owner-occupied practice decides to sell the building and simultaneously take a lease back on the property itself. So they change from an building owner to a tenant of the building. That will then release the value of the building, and the practice will in turn, usually the named partners, take a lease back, and it will be for a length that has to be approved and fully sanctioned by the health board, and obviously approved also by the district valuer in terms of value for money. But the concept is that the practice take a lease back of the property and release that money. That can ease succession planning in terms of partnerships, changes becoming easier to recruit partners, and they have to be sort of part of the lease, and it can be fairly easy to arrange things whereby partners can come and go. There are various things to consider about that, and I'm certain that Andy and Pauline will cover various advantages and disadvantages about this aspect, but it can certainly be one option. At the minute, as people will probably appreciate, the market isn't fantastic in terms of the values associated. In fact, we're seeing quite a lot of interest still, but at the minute, the market itself, has stagnated and fallen slightly in terms of capital values. Rental side of things, we're still seeing movement and growth and notional rents, but the capital side of it is, and there's therefore relatively limited interest unless you're talking about you've got a surgery of a particular size in a particular location, a particular standard. But certainly that is one aspect that can be considered. What changes obviously from a practice, what they have to really consider is this switch from the concept of being fully owned owner, where you can decide exactly what to do in terms of repair, maintenance, improvements to the building, even extensions or development, to becoming a tenant and having to then abide by covenants within the lease in terms of repairs and maintenance. And even though there will be a reimbursement that will be covered by the health board that will cover rental payments under the directions, there is this change in obligation and a switch in mentality from owner to a tenant.
But James, my understanding is that there are specialist investors who their business is about investing and buying surgeries. So there are businesses, and these are not just faceless landlords, but these are businesses who will own. You know, I think that the largest investor in the UK will own over 500 GP surgeries. Is that correct?
Absolutely. You've got the larger investors, you know, your Assurers, your PHPs of the world, and various others, and their model is indeed to acquire, to invest for the purpose of receiving that income stream. And then that's those valuations are driven by investment methods of valuation, and that's where you can secure, again, higher levels of capital value. And the intention by most of those investors is actually to continually improve property, to try and improve assets, to again increase rental growth over time. There are other parties that still do looking to get involved in sale and leasebacks, including doctors looking at pension, you know, fund purchases and things like that. So in this market, it's driven really by the size of the property, and there are all kinds of options out there.
Yeah, and my understanding now, you and I have exchanged emails about this, James, but my understanding, if you were going out with trying to get people doctors to come in and buy into to practices, the only way that current partners really can crystallize something that's in the same ballpark as existing use value would be to do a sale and leaseback. Is that an oversimplification?
No, it's generally right. So what a leaseback does is it provides to an investor this concept that the rental that is being paid under the lease is not only paid by the practice, but that is supported by an approval from the health board, who in turn will sanction and agree to approve that lease. So they're agreeing to reimburse the premises costs under that lease for that term. So that double covenant effectively allows the rental income stream to be enhanced essentially into a relatively strong capital value. Yes.
Yeah, when I described earlier on that sustainability loans had been destabilizing, a lot of what I mean there is that practices being given this valuation which they've never considered before, that the property's worth anywhere near that, and partners saying, well, hang on a minute, I'd like to have that now, please. And how do you achieve that? But of course, one of the issues, and the big issue maybe with sale and leaseback, is yes, you're selling the building and you're getting paid a substantial capital value. But the other side of that is you're signing up to a lease that will have specific commitments and obligations in there. That, I mean, James talked about repairs and such like. You lose the ability to be able to decide when you're going to redecorate or when you're going to carry out repairs, and instead your landlord will be saying you have to continually be maintaining the property in a good and tenant condition and repair, that you have to be redecorating the interior and exterior on a regular basis. And at the end of the day, that you have to hand the building back in a condition that it was at the outset. So you may have heard of reference to dilapidations in the context of leased premises. That's what dilapidations are. It's the costs of putting the building back into the condition which it should have been if you'd done all the things you should have done in your lease. Now, none of that's wicked or evil. Don't believe that this is sort of stuff that is only being foisted on the GP sector. These things are very, very standard in the wider commercial world. And where practices have had problems with dilapidations in the past, it's because they signed up to leases 20, 25 years ago, not really understanding what they were getting into. Or where they did understand what they were getting into. The partners who knew about that, having long since retired and left the problem sitting with the current partners. And if you've got a building that's not been redecorated for 20 years, then it's perhaps not surprising that the cost of redecoration are going to be substantial. But you do, if you're entering into one of these sale and leaseback arrangements, need to understand that you are taking on additional commitments that are very different from the commitments you have just now as a practice.
And I think, as you say, Andy, you get the value out, so it takes away the issue of valuation and what premises are worth. So you and I have got a practice which we're looking at, which is probably the right option for them in terms of sale and leaseback, because of where they are situated. But I suppose you are then tied into a lease with the liability of the landlord. I suppose now the health board are kind of honouring leases and taking leases on, so there's a wee bit of protection there, but you do lose income, and it goes back to what I said about earlier.
Yeah.
What profit do you make on your premises? So that's the difference between your rent and your loan interest, ignoring the capital repayments, because that's not lost money. You will get that later on if the value holds. So it's looking at, well, what will I give up? And I've done quite a few exercises over the past, and it tends to be the partners that are near retirement that are benefit from it, because obviously they've not got as long losing that income, and there's a tipping point income wise. But for incoming partners that they don't want to buy in, then sale and lease back might be an option. So it might be right for one practice, but not right for another. And it's exploring the pros and cons, and you'll have different views around the table, depending on potential age, views on having an asset rather than just a liability. But it's kind of flushing that out to just see what the options are and what's best for the practice longer term.
Yeah, and in some circumstances, you may have a building that really does need a lot of money spent on it. And in some circumstances, a prospective landlord, particularly one of the specialist investors, may be willing to spend some money on your building, and money that you would not be willing to spend on it. So in terms of addressing some of those obsolescence issues, it can be a way, not for every practice, but it can be a way to achieve that. And there are things that you can do to future-proof yourself in connection with these. So if you look back to the National Code of Practice for GP premises, that talks about the fact that over a period of time, we should be in a position where no GP contractor has to lease its building from a third-party landlord. That's not to say that you can't choose to do that, but it should be an active decision, not one that's foisted on you. So there are things that you can do in terms of what your lease says. For instance, saying that it can be transferred to the health board without having to get landlord's approval.
Yes.
But there are some requirements that the Premises Code of Practice talk about in terms of what your lease has to meet in order to be transferable to the health board. So it's got to be allow use for health and social care. And there are a number of other things that if your lawyer is familiar with the National Code of Practice will be drafted into the lease at the point when it's being entered into. And I think James, sorry. So James has picked up already on it. It's a prerequisite to getting rent reimbursement under the premises directions that before you sign up to the lease, that you have health board approval.
Absolutely.
So if you don't get pre-approval, you're not entitled to rent reimbursement. Alongside going and getting pre-approval, you may want to try and get some sort of undertaking or some sort of letter of comfort from the health board that they will actively take over your building at some point at a point in the future. And certainly the health boards where I've dealt with sale and leasebacks recently, they've been willing to give a measure of comfort. Not a carte blanche, yes, we will definitely do X, Y, and Z on this date, but rather more comfort for partners going forward.
And under sale and leaseback, there is tax payable. Potentially if there's been an up in valuation, because you are selling your building. So you're looking at your sale price, less any costs on sale, less what you initially bought it at. And you're looking at potentially 20% tax, because if you're still working in the building, you don't get entrepreneur's relief and get 10%. So you just need to be mindful of what kind of tax would be payable, but your accountant should be able to quantify that, even if it's just an estimate, just to give you an idea of what you would need to hold back.
Perfect. Thank you very much. Look, well, I think we could probably talk about the pros and the cons of these options all day, but we are running out a little bit of time. So, look, I think the main thing to think about from a practice point of view is just to ensure that you get the correct representation, the correct advice, just to talk through your exact circumstances and what option would be best suited to you. So just to ensure that you get the necessary advice, I think is probably the best thing that we can say. But look, thank you so much for you three. We've probably got 5 minutes or so just to perhaps go to attendees' questions. I've noted no one's dared ask a question yet, so I will kick things off, because I actually had a conversation with Ian Morrison from Lothian LMC last week, and he mentioned, which I think everybody is aware of, that a lot of practices throughout Scotland are struggling with dilapidations, and I know Andy's mentioned that before. But do any of you have any comments on perhaps how repair and maintenance of practices might be dealt with under the sustainability loan or sale and lease back?
Okay, so there's a path that's not well travelled at all under the National Code of Practice for GP premises. There's an assumption that sustainability loans are all about owned buildings, but actually the Sustainability Loan Fund is there to also provide support for leased premises. And it separates out those that you might pejoratively call good practices who have done what they should have done under the lease. They are entitled to a sustainability loan, no, a sustainability grant. And I've for a limited number of practices have tapped in and got sustainability grants from Scottish Government for that. But it also applies to what you might call bad practices, those who haven't looked after the building, and they also are entitled to a sustainability loan. And it's a loan that actually does have to be repaid, but it can deal with some of those immediate dilapidations costs that come through. Precious few people seem to have heard of that, but it is a thing, and it's a thing that if you're in that position, you should think about. Pauline will talk about building up of a maintenance fund as well if you are entering into a lease, but it is good practice, one, for your partnership agreement to say that you can build up a maintenance fund, so you're dealing with setting money aside every year so that those large elements of plant equipment being replaced, for instance, that you're not having to fund those out of one given year. But I'll let Pauline maybe talk a bit more about that.
Yeah, I think it's a real challenge in terms of dilapidations and providing in the annual accounts. Really, the best is looking at what the potential bill will be, and a lot of practices won't necessarily know what that would include. So it's almost looking to find out, well, what dilapidations costs would be, and you can get an external advisor to quantify that. And then it's looking at providing that on an annual basis and setting money aside. From an HMRC perspective, they need to see that money being kept behind, not spent, otherwise you don't get tax relief on it. And I suppose we've seen, Andy, a few practices recently where you kind of touched on it, where the landlord's happy to spend money to actually negotiate into another lease. So the practices are not having to commit to any dilapidations costs. They can't kind of come out of it clean, but actually money's pumped into the practice. So where you might provide for dilapidations throughout the lease, and then at the end you might have a pot of money that kind of goes back out to the partners, but they might be different partners at that point. But it's prudent through the lease to make sure that you don't have kind of last man standing with that liability. So it is a challenge. It's a challenge for accountants in terms of what should be provided on an annual basis, but absolutely right to provide, and making sure that partners take a cost as they go, and if you manage to negotiate something a bit better at the end, then that's kind of where you end up.
But again, I come back. These are not leases, are not wicked, evil things that are there to trip people up. They are absolutely standard commercial tools right the way across the business world. The challenge for medical practices in the past has been that they have not understood what they're signing up to, and haven't understood the full detail of that. If you are leasing, be that if you're a practice that leases a building already, or you're into sale and lease back, you need to understand and actually do some forward planning as to what is it you're getting into. And then what mitigations can you put around that to be able to deal with that? And building up a maintenance fund would be one thing. Understanding what your lease obligations are. So if it says you have to redecorate every 5 years, you do actually redecorate every 5 years. You don't just make do and mend and hope it'll be okay on the night, because at the end of your lease, your landlord is going to want their building back.
And there's regular systems like programs of planned maintenance that can be drawn up at the start of a lease that will use this maintenance fund to address any ongoing issues and maintenance that prevents a relatively minor issue becoming a huge issue towards the end of the lease. It is relatively common in medical centre leases for reinvestment at the end of the lease into re-gearing a new lease, but we can't always rely on that, so it's essential.
Brilliant.
Well, I think we've got some questions now.
We have, yes. I was going to say, yes. absolutely. So Ed and Kevin have asked how successful notional rent appeals are when health boards seem to be so cash strapped.
So from my perspective, I would just say that the concept of notional rent is a market rent basis, and that can't be linked to budgetary considerations. And that's not to say that there isn't pressure on the district valuer from various sources, but it is, strictly speaking, a market rent based system. So if there is justification, say for whatever reason the notional rent assessment is potentially incorrect, or there's part of the building that hasn't been included in the assessment, I come across this quite regularly, that maybe the measurement that was adopted has actually changed over time. There's been never any reassessment of that. That needs to be corrected, then it will be corrected. And from that aspect, notional rents are kept aside from budgetary considerations. Things like application for additional space or improvements, those can be affected by budgetary things, but the notional rents are driven by a market rent discussion. How successful are they? Well, that depends on whether the assessment, broadly is right at the time. Every single building is different. It's a heterogeneous sector. So some assessments we will find actually are quite underfunded and need to be corrected quite considerably. Some are absolutely where it needs to be. So it is case by case.
Perfect. Thank you, James. Which I think is why it's so important just to get it checked. There's no harm in just getting it checked to see where your notional rent is at. A lot of surveyors will do that on a free basis anyway, so certainly worthwhile asking the question. But thank you for that, Ed and Kevin. Right, okay. So Michelle has asked, if you anticipate that the current use market value is lower than the alternative, so i.e. private home use, does that generally mean sustainability loan is not a good option?
I would look at a sustainability loan. I think the value in my eyes doesn't really matter at this point. It is really a mechanism for giving you free money and allow you to swap loans that you've currently got. So I think down the line there's an issue on valuation, but this is purely to calculate what you could take out as a loan. And with high interest rates and succession issues in terms of how do you buy out ex-partners, you're just swapping debt, taking equity out. As long as you're aware of what the implications are, I still think it's a good idea on the sustainability loans. But I think it's looking at each practice. So Michelle, I would suggest that you speak to your accountant or you speak to us and let us look at that situation to see whether that would be right for you. But it's remembering it's not a value to sell at the moment. It's just a mechanism to give you funding.
Absolutely.
Fantastic. Thank you for that. Right. OK, so James has asked, he said our health board have been slow to pay first payment of the sustainability loan and as yet haven't progressed with any lease assignments. Any update from your side on reasons for this or on time frames to see outcomes?
Well, I think it's back to what I said when I was talking about sustainability loans earlier. There was a nationwide policy, but it was then dropped onto each health board area to decide how they were going to implement that policy. If you looked at Grampian, and I'll shout out for Grampian as having been early adopters in terms of driving forward their process, they were significantly ahead of some other health boards. And I know that there's one health board I can think of that's only drawn down in 2023 its first sustainability loan. So I think it really comes down to the priority that health boards give to putting the process in place. Lease assignations is there's more complexity there for health boards.
Fantastic.
Thank you.
Yeah, good. No, I was just going to say that's fine. That's great. Thank you for that. Has anybody else got anything to add, or should we go on to the next question? Okay, no problem at all. Right. So look, Ed and Kevin have asked another question. So they're trying to get their money's worth, which is great to see. So any thoughts on structuring ownership as an LLP or a limited company? As a previously sole owner, I'm pleased to have formed an LLP with my sons, guided by Pauline's company, Condies, which is great.
Brilliant.
So Pauline, are you going to go first or will I?
Oh, Andy, you love LLPs.
This shows the fault. This shows the fault line between perhaps lawyers and accountants. Lawyers love limiting liability. There's a reason why my business is Davidson Chalmers Stewart LLP, And that's because I take a significant amount of comfort from the fact that the money I have invested in my business is at risk, but my house and my personal assets are not. I think it is fair to say that we see the vast majority of GP practices are still traditional 1890 Act partnerships, but whereas if you went back 5 or 6 years ago, I think I would have had 2 practices that were LLPs. We now see an increasing numbers who are looking at what does that mean and does that provide benefit. I know that it causes more problems on the accounting side in terms of the additional work that your accountants are having to do, and in terms of the costs that go with that. But from the lawyer's perspective, removing risk, individual risk from partners is a sensible thing, and is a thing that addresses some, not all, but some of the recruitment issues, because you no longer have young partners who are not contaminated with the business facing joining an 1890 Act partnership and becoming contaminated. Instead, they're joining a limited vehicle. But Pauline and I have debated this many times.
Yeah, oh, I totally agree with limited liability. Absolutely. In fact, our business is a limited company, so we absolutely look at limited liability. I think it's identifying what your risks are, and I think there's tax implications on bearing a business from an LLP into a limited company, and in a limited company there's superannuation issues, that you can't superannuate dividends in Scotland, but you can in England. There's lots of things to unpack there in terms of kind of tax, superann. So it's probably not for today, but and also LLP and limited company, it's private, it's on company's house, there's more available data there. So I think, yeah, absolutely, I think it's something to explore, especially if there's a lease there, but you just know that there's some implications that need to be addressed, and it's not right for everybody, but it's certainly something explored. Thanks, Ed.
Perfect.
If any of you did want to go and drill down into what LLP actually means, there's an article on my website that's about LLP Incorporation for medical practices, and you'd go and dip into that, and you'd find a little bit more that's involved there.
Brilliant. Thank you for that, Andy. It sounds like you might have opened a bit of a can of worms there, but yes, hopefully maybe that's one for another webinar further down the line. So look, let's just finish. I know we've gone over by a couple of minutes, so we'll just finish very, very quickly with some takeaways from James, Andy and Pauline. Do you have kind of what are your main takeaways that you think it'd be useful for the attendees to go away with, the practices to go away with today?
Can I start?
Go for it.
Please.
Go for it.
I think it's understanding who owns the property, and who shares are, how making sure that income and costs are reflected correctly in the accounts, and shared between the correct partners. I think it's understanding valuation methods and how your valuation is applied in your own, and the implications of different valuations. Absolutely make sure partnership what is intended when it comes to property and any other matter. The only time that you will up your partnership agreement is when there's a dispute, and then it's too late. You do a partnership agreement when you're all happy and all on the same page. So partnership agreement is crucial. We've seen a few partnership disputes over the years, and it's just not a nice place to be. Review existing loan funding, make sure financial financing structure, especially at the moment with interest rates and sustainability alone. I would seriously look at your outgoings, and in some cases sale and lease back. Absolutely take advice and make sure that you're getting the best advice to make the right decisions, because it's kind of big money.
Brilliant.
Very, very briefly from me, it would be, again, to reiterate, concept of the partnership agreement is understanding what's in there and actually agreeing what's in there. And from a valuation perspective, I have come across partnership agreements that actually don't make a great deal of sense as to in terms of how the property is valued. So it's really understanding how they're structured and what it means, and that everyone's agreed to those. Good estates management in terms of improvement of buildings, to look after them, to look after the building, look at where they can be improved is great. Look at your notional rent when that is reviewed, look at whether or not that can be reviewed, whether that's right, whether it can be maximised or not. But there would be a couple of things that I'd highlight.
Yeah, and I think for me, from me, remember you're in business. You are running your own business, and you need to understand what your business risks are. Number 2, don't take no from your health board. Just because the health board says no doesn't mean that's the correct answer, or that's the answer that they can't be persuaded otherwise. And as others have said, have a partnership agreement that is actually just designed for a GP practice.
Brilliant. Thank you all. So look, I hope you've all found a few nuggets of useful information. If you do want any more information, or if you have any questions or queries that you think about in next week or in a month's time, feel free to get in touch with either myself, James, Andy or Pauline, so you can get in touch with us through your local LMCs. So that's it for today. Before we finish, just a very, very quick thank you again to Lothian, Grampian, Lanarkshire, Arran Ayrshire, Borders and Forth Valley LMCs for helping put this webinar together, and a huge thank you to James Williams, Andy Drane and Pauline Hogg for your very, very interesting, insightful knowledge on these topics. So look, that's it from us. Have a great evening. Goodbye. Hopefully see you all very soon.
Okay.
Brilliant. Thank you.
Bye-bye.
Thank you very much.
Bye-bye
Good
now.
night. Bye-bye.